Welcome to Cherry Bekaert Government Contracting Podcast. My name is Brynn McNeil, and I'm an audit partner with a focus on serving government contractors within our professional services industry group. Along with me today, I have Craig Hunter, who is a fellow audit partner in our professional services group, also focusing on serving government contractors. Today, we'll be focusing on revenue recognition, and by the end of this podcast, we are hopeful that you'll have a better understanding of the overall guidance for revenue recognition, as well as common errors and best practices that government contractors should have in place as it relates to revenue. With that, Craig, do you want to kick us off by just kind of outlining the guidance and letting folks know kind of what rules we need to be following?
Absolutely. Thank you, Brynn. So starting with that high-level refresher of the Revenue Recognition Standard, ASC 606. During this time, we'll drop into a couple of items, but the 606 standard is really a large standard. We're just going to be focusing on some key items here. So the 606 methodology requires us to follow 5 steps, and we're going to go through all of those briefly. The first step of the 5 is to identify the contract. This requires that approval and the rights by both parties are identified, the payment terms are identified, that commercial substance exists, and that ultimate collection of the billed amounts is probable. So those items have to be in place for there to be a contract in place. The second step is to identify the performance obligations in the contract. Now, a performance obligation is a distinct good or service, or a series of distinct goods or services. An important term here is distinct. So if a customer can benefit from this promised good or service on its own or by combining it with other resources readily available to it, then that good or service is capable and determined to be distinct. An example would be a contract where there was within the same contract, a single contract was the sale of software, implementation of the software, ongoing support, and a number of different obligations that the company is actually undertaking to do. In that case, you'll need to look at each of these obligations and determine whether it's distinct or whether we are going to bundle them together into a single contract. So that's important. So that's the second step, to identify the performance obligations. The third of the 5 steps is to determine the contract price. And that's generally fairly straightforward, but for the concept of variable consideration. So this could include award fees, performance and cost target incentives, reimbursement for expenses, things like that. There, the requirement is to include in the transaction price, to the extent that it is probable that the inclusion of this variable consideration will not result in a significant reversal of revenue recognized. So in other words, the standard just says we don't want to over-record revenue, and you'll book what the best estimate is of that variable consideration. So that's step 3. The fourth step is to allocate that price that we've identified to the various distinct performance obligations that we've also determined. And then the fifth of the 5 steps is to record and recognize revenue when that underlying performance obligation is satisfied. So there we can record it revenue over time or at a point in time. For revenue to be recorded over time, one of 3 factors or criteria have to be in place. The first is the customer receives and consumes the benefits as they're performed by the company. For example, hourly projects or program support, where you're out on a customer site, as that hour is delivered, so the customer has received that benefit. So that's the first one. The second one would be where the entity creates an asset that the customer controls. For example, here would be building a structure or a piece of equipment on the company site. And as this equipment gets built, so they control it because it's on their site. And then the third one is the company creates an asset with no alternative use and has to be and the entity has the enforceable right to bill and collect. With certain government contracting work, the alternative use may be a fairly easy part of that, but the important part is also the second part of that requirement, the enforceable right to bill and collect. Now, governments and contracts with the government generally governed by the FAR, which allows the government to terminate a contract at any point in time. So FAR subpart 49.2 addresses the principles of, or for determining the settlement amounts for fixed price contracts that are terminated for convenience by the government. So having this contract term in place is important, because that will allow you to be able to bill for work done, and that way you're able to bill for all your costs incurred plus an element of profit. So that contract provision in place really makes it that the company does have the enforceable right to bill and collect. So contracts or revenue recorded over time is going to be determined by either an output or an input method. Output methods are generally units produced or delivered to the customer, whereas input methods rely on the efforts put into the satisfaction of the underlying performance obligation. For example, hours incurred, labor hours, or costs incurred to date. So those are the two criteria for and ways one records revenue, either at a point in time or over time. Revenue recorded at a point in time will generally take place if none of those other three factors are in place. So that at a high level, those are the 5 factors that one needs to consider and really look at for each and every contract that you undertake as to how it should be recorded and the underlying revenue recorded.
Great. Well, now that we kind of have the basis and the overarching guidance for revenue recognition, kind of thinking specifically to government contractors and kind of generally speaking, so not saying that every company is like this, but generally speaking, we do see that a lot of companies are more service driven, especially when it becomes to the performance obligations, as opposed to manufacturing and producing inventory per se. So kind of thinking through a government contractor and the concept that they are a service-based professional services type firm, when you kind of look at revenue and the recognition there too, really what's kind of driving that revenue stream are the true underlying costs. And when we kind of think about the costs of a traditional government contractor that's service-based, really your direct labor is a key component of your revenue recognition because it's such a significant cost to the company. So one key piece of cost that we like to think about, or especially consider when you're looking and thinking about revenue, is really that direct labor and the concept of the timekeeping and labor controls that you have in place, because that whole cycle and system is very important and relevant, because you want to make sure that you're properly charging your time and that the employees are being properly paid so that your costs are recorded and therefore your revenue is recorded properly. Another significant component when you're kind of thinking through your cost structure are your other direct costs. So some companies may have significant travel incurred on their contracts, or significant subcontractor labor or materials that are being purchased. And so you want to make sure that there are proper controls in place and that you're truly charging those direct costs to your contracts, because those costs are in essence what's really going to be driving your revenue and whether or not it has been properly recorded. So we just like to overemphasize the point of cost kind of driving revenue for many government contractors, and making sure that for those controls that you have within your company, that there are appropriate controls so that those costs are being recorded appropriately and as a direct cost to these contracts.
That's exactly right, Brynn. And as you mentioned, therefore, if we touch on just the revenue recognition for each of the 3 contract types, for time and materials, so all those contracts where people were putting in hours and recording their time, the revenue would be the hours expended at the agreed contractual rates within the contract, and those rates would be fully burdened. So those invoices tend to be fairly straightforward. An important point to remember is the materials part for a T&M contract. One could be able to burden that with a material handling rate. So if the contract allows for it, certainly make sure that you're billing that piece and don't give that up to the government. For cost reimbursable contracts, all the costs accumulated that Brynn mentioned, plus an allocation of indirect costs, is what you will bill on a regular basis. And those indirect costs would be a function of your provisional or approved rates at that time to make sure you're getting those, getting the indirect costs back and being able to recoup that. And then on the fixed price contracts, generally what's used is it's a function of costs. So costs incurred to date as a percentage of the total costs multiplied by the overall contract value. So very important to have all those underlying costs recorded, because if in the event they're not recorded, you're not going to record the related revenue. So that's really looking at the three contract types. Now we do see a number of errors Brynn, as we go through. So do you want to touch on a couple of those?
Yeah, so just kind of following the same pattern in the sense of contract types. So thinking you initially mentioned the time and materials and T&M contracts, and while the revenue recognition is straightforward in the sense of you're truly just billing at the agreed upon rates in the contract times the hours, oftentimes we'll see that there's newer rates on the contract, or that especially in an option year, there are different rates for the contract and for the employees. And sometimes they're not charging the new rates and the correct rates. So we do see that. Other times there can be issues with timesheets. So going back to just kind of having those controls in place to make sure that hours are properly recorded and approved. Where we will see issues on the T&M is if the rates aren't correct or if those hours aren't correct. Looking at cost type work, you mentioned the indirect rates, and those are a key component of cost reimbursable work. And we have certainly seen a number of companies that are not really paying attention to and monitoring those rates, like you mentioned. Traditionally, companies are recognizing revenue during the year at those provisional agreed upon rates. But at year end, it is very important that companies are going back and looking at what the actual rates are to making sure that they are doing a true up, so that they have not overrun or underrun the contracts and the revenue recognition. Another piece on the rate work is just some contracts do have rate ceilings within the contract. So they want to make sure that you are paying attention to those and that you have not recorded anything in excess that's been allowed by the contract. So I think that's another key piece. And really, when we look at companies and we're doing the audit for the companies, sometimes where these issues come up and where we'll see it is really in their unbilled or their contract assets. So ensuring that that's been properly reconciled or reviewed sometimes can even help clients identify some of these errors within their cost type work. And then on the fixed price work, oftentimes where we see the most error recorded or where revenue has not been properly recognized is really when companies, and specifically their project or program managers, are not really performing estimates to complete, or they're not necessarily including the best estimates or capturing all of the costs within those. So, having the ability to truly understand what is left on that contract in the sense of total costs, where are we with the contract, and being able to perform a solid and kind of reliable estimate to complete is certainly going to impact the revenue that you've recognized. And then another issue that we've seen on some of the companies is that, one of the provisions under the ASC 606 guidance that Craig kind of kicked off with is that if companies are experiencing losses on a contract in a given year, they really do need to be looking ahead, and are there any forward losses? And if future losses are anticipated, the guidance says that those are accrued for, not obviously the actuals, but just the estimate. What is the best estimate of that loss, and that a provision is being recorded and accrued for at year end. So I think those are some of the most common errors that we see when it comes to recording revenue. Just kind of switching gears a little bit, then what are some best practices that you would encourage companies to have in place to help avoid some of these pitfalls or errors with revenue recognition?
Yeah, the first one that comes to mind, Brynn, is really just correct system setup. If companies are using one of the traditional government contracting softwares, CostPoint or Uninet or even QuickBooks, just having someone that's qualified and experienced to set up the system to ensure that costs are accumulated, that invoicing is appropriate, is something at a very base level. But we've seen many companies that haven't set their system up, and there's just a lot of work throughout the year that really gets, takes time and effort from folks in the accounting department.
Yeah. Another one, I know I kind of hit on this, and we were just making mention of the revenue streams and kind of what drives revenue, but the timekeeping process and making sure that you do have that appropriate timekeeping system. And then more importantly, that you've got the controls there too, as it relates to the timesheets and to the rates and the pay that is going in. So that timekeeping control and process is really important, since labor is traditionally one of the most significant and largest costs for these companies.
Right, absolutely. And another one of that people can look at to do is really documenting all contracts. Now, with the government, most of the time the contracts are well documented and signed off, but we do see a number of instances where there's a verbal notice to extend the period of performance, and sometimes these verbal agreements, while they're good at the time, over time they may be challenged. There might be a turnover in the contracting office department. So advice would be to always get contracts documented, so one has some documentary proof to go back to support what's being billed and just the general contract terms.
Yeah. Another one I would just say, especially if you're doing more of the kind of cost type work, is that you're really reviewing your indirect rate structure. And are you taking advantage of optimizing that structure and making sure that you're getting the most that you can out of your rates? And, that's one area where sometimes the companies can be recouping a lot more if they maybe just monitored that rate structure or took a look at that, just to make sure that they are set up in the most advantageous way for the types of work that the company does and performs.
That's a great point, Brynn. The other one I could think of is just for companies to have a robust and a routine, regular financial statement closing process. So really the closing, the monthly hard close and reconciliation of all accounts, including the contract asset or liability, aka unbilled, is crucial, because when we get in there as auditors, we very often find issues in the unbilled account that hasn't been scrubbed for a long time. And when we make adjustments to that account, the other side of that is generally revenue. And no one likes to see hits to the P&L or adjustments or surprises to the P&L. So routine and regular full closings is something we would certainly advise.
Yep. Yeah. So even just having that regular communication with you as a CPA to make sure that their revenue recognition is appropriate is always just a good tip and trick. And I know you're certainly always open and willing to talk to your clients or companies. So anyone should take advantage of that. Well, with that, Craig, thanks for joining me today. As I mentioned, Cherry Bekaert does a lot of podcasts within the professional service industry that Craig and I both serve. So we'll hope that you join us for some of our future podcasts. Every single podcast that we do is posted on cbh.com. But as always, if you have questions or needs, please feel free to reach out to us. Craig and I are always here and happy to help. But thanks for joining, and hopefully you got something out of this one.